Today's guest on the Worldly Wisdom podcast is Matthew Peterson, managing partner of Peterson Capital Management. Since founding Peterson Investment Fund in 2011, Matthew has been focused on building long term wealth through disciplined, value driven investing. With 2 decades of experience, he's worked with firms like Goldman Sachs, Morgan Stanley, Merrill Lynch, and led high impact projects all across the world, including the US, UK, and China. A CFA charter holder with a background in economics and math, Matthew brings a unique blend of institutional insight and independent thinking. He now lives in Austin, Texas with his wife and 2 children. Please welcome Matthew Peterson.
Thank you, Heriday. It's a pleasure to be here. Thank you for the warm welcome.
Yeah, thank you so much for joining. So to kick things off, I would just like to start with obviously my book is shaped a lot on learning from mentors and learning from key figures or people that have really shaped your investing journey. So just to begin with, I would like to ask you, for you, who do you think are the key figures or mentors that you think have shaped your value investing philosophy or your philosophy of life in general?
Oh, absolutely. Great question. Obviously, the Oracle of Omaha, Warren Buffett, has been a key player in my life for, I think, 25 years. And then Charlie Munger, soon after, was very important and instrumental in guiding all of my thinking. I've been going and attending the Berkshire Hathaway meetings in person since 2004. So this will be, I guess, year 21. I think I missed a couple of years when I was living in London, but every other year I've been there. And there's a whole host of additional people who have been uh, very helpful in guiding the direction of our firm and investment philosophy. And I think they're kind of I know many of them well now, but everybody from Guy Spear, Monish Pabrai. I like to see what all the super investors are doing. I watch what Lee Lu's doing. I watch what Bill Ackman's doing. I watch what David Einhorn's doing. So I follow a lot of these folks, but I think importantly, they don't all have to be alive. In early maybe 2005 or six, I asked Charlie Munger a question at the Berkshire meeting. And I asked him, when they're not around, who we're supposed to look to for guidance. And he was very clear with me that the big mistake people make is they try to find guidance from people who are alive, and it's better to make friends with the dead. So he encouraged me to go out and read widely. And obviously, many people on your podcast have read books like Security Analysis or The Intelligent Investment by Benjamin Graham, the Intelligent Investor by Benjamin Graham. Uh, but I think Phil Fisher is actually a very important mentor when it comes to finance. So Benjamin Graham always taught, that you have to buy at this deep discount to intrinsic value. You want to value these businesses. And he's always looking to pick up maybe 50 cents for a dollar for 50 cents and then get an additional margin of safety. So it's pretty hard to lose money. But Benjamin Graham wasn't ever very focused on the growth of the company. He was really looking at the financials and ratios and the current state of a company. And so that's what got Buffett into these cigar butt ideas. So this situation where there's a really maybe lousy company, but it's so cheap that there's actually some cash flow coming before it maybe goes bankrupt or out of business or there's a corporate transaction. So Phil Fisher came along and really influenced Buffett's thinking and basically informed Buffett and Charlie Munger really put this into practice and moved sort of Buffett's thinking from this short-term sort of repeatable process where you're picking up little pieces of money into buying great businesses that are growing. And it's very difficult to get these prices that Buffett loves in the great businesses. But if you're very patient, you wait for a crisis, you get an opportunity to upgrade into quality. And that's been, I think, what Buffett's been doing very well for the last few decades. And all of that is very influential in the way that we manage our fund and the assets for our clients.
Yeah, Yeah, that's great that you talked about it because I generally I see a lot of people, even for me, beginning onwards, you start with Graham and you start with intrinsic value, security analysis, Dodd, and then you sort of move on to Phil Fisher, or you move on to more quality-based investing, which I mean, in Graham's time, it made more sense to find net nets or a discount to tangible book, or focus on these kind of these kind of things, because it was the wake of the Great Depression. And then out here, all these corporations in America, they're selling at huge discounts to what they're actually worth, if you just see the value of their assets. And then as we grew, and it reached a point where now no longer can you find net nets, or even if you find such companies, they're mostly horribly run, mismanaged companies. And you don't really want to, as Buffett said as well, you don't want to be the guy who takes the last puff of the cigarette. Because you never know if it works out, and nowadays a lot of these opportunities no longer exist as well. So yeah, it's
Hardy, I'll add something to that. That's absolutely right. But there's something more, and it's Peter Kaufman, who wrote for Charlie's Almanac,
Mhm.
and is the CEO of Glen Air in Los Angeles. Is just a wonderful person. He's written quite a bit, and he's absolutely brilliant. So I was meeting with him a few years ago in LA, and when we had a chance to talk about some financial opportunities, I was explaining some things to him, and he literally brought out a safe to me, handed me a safe, and he said, "Here's the challenge, Matthew." He said, "You know the code to the safe. The code to the safe has been preached in all of these books, and Ben Graham used it, Warren Buffett used it, Charlie Munger used it, and you know the code. And Herda, you also know the code, and so does everybody else. The code is based on free cash flows and return on equity and all of these ratios. The challenge is when you use that code and you open up the safe, he literally showed me the safe is empty. The money has been taken. So the easy money in the Ben Graham nets are gone. Things trade at different prices for a reason. Yeah, value investing goes in and out of vogue. So you can find things that are trading below cash. But, 50, 60, 70 years ago, people were just not that familiar with these types of opportunities. So they were everywhere.
Mhm.
Currently, the situation's much more challenging. There are thousands of analysts, thousands of die-hard value investors trying to scoop up every Ben Graham net on the market, and that doesn't leave very many. So at this point, you have to do something different. And the major evolution that the top value investors seem to make over and over again is they move on. They still focus on financial statements, but they move on from just buying any company cheap. We call them the melting ice cubes.
Mhm.
And now they go and they try to buy outstanding businesses. I would rather own a company like a Google or an Amazon than a company like a General Motors. There's just way more potential, way better return on equity, way better business model. They might trade for what appears to be a similar discount, but one has a clear path to the future, and the other is a struggling metal stamper. So these are major differences in how you move from Ben Graham to Phil Fisher. And the challenge with the Graham methodology is, as Peter Kaufman explained to me, there's just no money left there.
Mhm. Yeah, the I really like the Pierre Kaufman analogy in that story, and it really shows how the market's getting better at valuing these things. Charlie and Buffett have been here for so long, telling everyone, out in the open, this is the way to do things, and then they've molded their philosophy as well. And so people are just getting better at figuring out what's going on. So, and my second question is kind of linked to this. I know from your letters and your fund and stuff, you're someone who's very, very bullish on the applications of AI and um, uh, all these algorithms and this information that you have an access to for value investing and the analysis process. And I remember actually you had a tweet where I think you said 80 to 90% of the job that you get a analyst to do, you can probably do in 15-20 minutes with AI or using deep research nowadays and stuff like that. And I think your fund has also built an AI app for this, or has an AI platform. So could you talk more about it? Of course, how you use it currently, and with so much
Of course.
information now available to people, what do you really look for that differentiates you from the crowd and keeps you independent from what everyone already knows?
Faraday, you've done your homework. All right. So let's talk a little about the technology platform and AI. And to bridge from the last question, I will share that not only is the market getting more efficient, but the data and access to all of the metrics and finances are more available. So in the 50s and 60s, if you wanted to get special information, you'd have to pick up the phone, call the company and order an annual report and have it sent to you or send you a series of them. And then that information was right at your fingertips and nobody else, not many people were out there doing that sort of activity. And so you could find all sorts of mispriced securities. But today, you can just go to a Google, you can go to Yahoo Finance, you can pay up for Bloomberg or Cap IQ, or you can do what we've done, which is built some proprietary software in-house. And suddenly it is very efficient to get all of the data. So the market becomes more efficient because the data is so available and everybody's trying to consume it. There's incentives, financial incentives behind being the leader in the data consumption. And so what have we built? Well, Heraday, would you like me to show you some why don't I show you a few things and I'll let you edit this in the future and determine what's good and not. So the website that we have, anybody can visit petersonfunds.com. And if that's the easiest thing to remember, we have links there to our beta AI analyst. The actual website is veritasalpha.com. We have several real-time reports that are driven by AI. These are totally free. We use them internally on a daily basis. We've been developing this over a series of years. And ultimately, this is totally transforming our workflow. And it already has. The activities I do on a daily basis now are significantly different than what I was doing 3-4 years ago. And it's still very much embedded in deep research, but we have most of the research done in advance for us. So why don't I simply share the screen? It's not probably as standard podcast, but I can share a few things and your viewers can decide if they like any of this. So why don't I wasn't, give me one moment and I will share this. Let me find a proper screen. All right, wonderful question. So here's our technology platform. This is veritasalpha.com. I will show you here today. All you do is you simply click financial report generator. And on the left-hand column, we have several different reports that you're able to order, and you can order them real time. Basically, this is linked up through the APIs. It sits on top of the LLMs. It's linked up to the APIs to all of the SEC data, and it can go out and get all sorts of other primary resources like transcripts, earnings releases, and all sorts of things. And we have that all paired up. And it gets and goes and gathers about 10 years of data for any company that we want to look at. So let's just say hypothetically, I wanted to do an analyst report on Google. I would simply type in the Google ticker. I'd put in my email, matthew.peterson@petersonfunds.com. I hit generate report. And there's a complex multi-step process. Thousands of lines of code are now running in the background. The planets are aligning. And we have hundreds of prompts we call prompt libraries. And these prompts are running and producing a comprehensive analyst report that would take a senior analyst weeks, maybe a month. In 20 minutes, it will be delivered to my inbox. Heraday, you can go and order any of these reports that you'd like. There's thousands of companies in America. You can just order any one and you can order thousands. If you'd like, this focuses on SWOT analysis, 4 to 5 forces. It does a scuttlebutt analysis. It does evaluation where it goes through a bull bear base case DCF analysis. It goes through NAV calculations, some of the parts calculations. It does a totally unbiased short thesis. So you can get the short thesis. And then it basically draws up a conclusion. And the information I'll show you in a moment, it's so superior to what a human can do. We've actually had this system take and pass the CFA exam. This is like an incredible analyst, an incredible tool in my pocket. When I'm meeting with executives or a client, potential partner in our fund, when they mention something, I just pop it into my AI tool. And when I leave the meeting, I have reports on every single company analyzed as if I've just spent a month. Same thing for the earnings analyzer. This focus on the last 3 months in particular. So if you want to focus on the latest earnings call and you want to get it to summarize everything that's happening with that company, you just do the same exact thing. I'm going to ask about the information on Amazon. I'm going to get that report coming into my inbox. There's also a total market insight. I'll show you these reports here today if it doesn't take too much time for you, and you can always cut it out in the end, but total market insights is incredible. Basically, I've been working very closely with the Century Management team. Legendary value investor Arnold Vandenberg is the head of the firm. We've become good friends over the years, and ultimately, we are working and collaborating on a lot of these reports. I'm building this for myself, and I'm also building it to assist his firm. And ultimately, there seems to be a lot of demand actually from external firms. So we probably have a SaaS business here in the future. This total market insight, I'll explain. But again, I'm just going to request that report. It's going to come right to my inbox. So all of those things are going to be showing up in my inbox in a few minutes. And ultimately, why don't I walk you through what's happening here? Earnings calendar is very interesting as well, but a little more difficult to show you. So we have these reports I've ordered. And in 20 minutes, let me start with the total market commentary. All right. So what is that report showing us? We worked on this for quite some time, and we started with analyzing a single company. We just created something. And when I say we, I'm talking about myself, my analyst, Andrew Park, our developer, Surya, and a few other people from Upwork and a few other key individuals that have been helping us develop the software. What we wanted to do is we wanted to build a report that would look across the market, and it would analyze 20 years of data. And it would ultimately help us understand the multiples, expansion, and contraction range. All right. So what did we want to look at? We wanted to identify a few key metrics: price to book, price to sales, price to earnings, EV to EBITDA. And we wanted to gather all that data across 20 years. We started by mapping out a perfect one-pager for Apple. Once we had that page defined and created the way we wanted to see it, I asked my analyst if he could go and run the software on the S&P 500. 3 hours later, we had it for 500 companies. Then about a week ago, I said, let's run this overnight on the Wilshire 5000. And 14 hours later, we had the document that I'm showing you. It covers thousands of companies across America, and it shows you exactly what's happened recently and over 20 years with these metrics. So,
yeah,
yes.
I think your screen got it
Frozen.
yeah, it's not sharing anymore. You could.
That's okay. Wait, I will share it with you right now.
Sure.
So we started with Apple. This is T. Rowe Price.
Uh-huh.
Uh, so this is a much larger document. This document now contains
Uh-huh.
2,502 firms. We've also had it sort these documents, all of these companies. So, and we've assigned it a series of points just so if anybody uses this, they understand what's happening.
Mm-hmm.
Very importantly, we care a lot about the return on equity. If your return on equity is high consistently over a number of years and decades, you're ultimately going to be sort of earning about that return. Like if you bought into a company at a fair price and they're getting a return of equity around 12% year over year over year, over the long term, you're sort of going to asymptotically approach this rate of return of about 12%. All right. You're not going to do a whole lot better unless the multiples expand, and you're not going to do a whole lot worse unless the multiples contract. So what we wanted to see here was we took and assigned points and lifted the ROE, the high ROE performers into this sorting system. Then secondly, we look at ROA, price to book, price to sales, price to earnings, EV to EBITDA. And you can see those in this chart. And what we wanted to see is where is a situation where the multiples have contracted, where the price to book is at the lowest level it's been in 20 years, but yet the ROE is still climbing higher and higher and higher. Great business, great ROE, super low compressed multiples. Okay. And part of this is that in the conversations I have with Century, and Arnold is a world-class investor, 85 years old, Holocaust survivor. He has a 50-something year track record in the teens. It's just incredible what he's accomplished. So when you're looking at a document like this, it's like you don't want to buy into a great company unless you're paying the lowest multiples in 20 years. Otherwise, there's going to be a chance 3 years from now for you to pay less. So as you look through a document like this, 2,500 companies across the United States, we tried to sort ones that look pretty great to the top. So you can see all these multiples are compressing. So where PayPal used to have commonly price to sales that were sitting in the fives, fours, it's at 1.9 today. Now that's more interesting to us to maybe go and explore deeper. We see Nike up at the top. We see Lululemon up at the top. We see a lot of different great companies that Bank of the Ozark, they filter right to the top. And of course, if you scroll to the bottom, because of our sorting system, you'll start to see the companies where the multiples have been expanding over 20 years. And if you get a multiple expansion over 20 years, now you're suddenly paying the most for those earnings that you ever have. And if we enter a recession or we get into a contraction period, you would anticipate the multiples will contract and maybe even the earnings contract. So when you get into these companies in the second half of the document, you're going to find lower return on equities and bigger multiple expansion. So you're paying more for less for the firms at the bottom, and you're paying a lot less for a lot more for the firms at the top. So we find this just incredible. It would take an analyst a day or two with their other busy things going on to put together a document, a one-pager like this of 20 years. And then this AI is allowing us to absolutely scale. When we make it right for one, we can then run it across the entire market overnight, and we get it for all 2,500 companies in this document. So this is just incredibly important and valuable scaling tool, and it puts us so far ahead of people and firms that are doing this research manually. Herday, do you have any thoughts or questions on this document? What do you think?
Yeah, I think it's fantastic. I think it's gives me sort of Buffett's Moody Manuals kind of vibe where
The
um,
value line. Yeah, that's
you
right.
just flip through, different companies, and somewhere there you're gonna find a bargain. But except, this time you've got AI making it easier for you to find the bargains by placing them at the top or giving them more emphasis. And you've got the key metrics lined up, and I could see, very well that over a period of time this could become even more informative, and you could have all sorts of things generated, and you could basically have a document on all the companies I mean, I know this is the Wilshire 5000, but you could have a document on all the companies trading in the United States, and then it becomes just so much easier to find the kind of company that you're looking for and what you want to get. And I think it takes a lot of time finding for opportunities, and this makes, um, getting opportunities much easier, which is, or basically screams to your face that, okay, these ones, you should look at, which is, I think it is pretty fantastic, and you can't get this kind of stuff, you know, online anywhere else, or even in Value Line and even in Moody's manuals. Sometimes they haven't got a sorting system, and you can't in any way get the companies that you really want to look at, and yeah,
Faraday, that's right. I mean, this is information you might be able to grab out of Bloomberg, Cap IQ, and then sort of format in a certain way and then sort of verify some of the numbers. So it's not like it's impossible to create one of these, but in the past, doing it manually would make this so time consuming that you might spend a quarter building out a document like this, 3 full months to get a document right. And then by that time, the early companies have changed, prices have moved. You have to sort of run it again. It's very hard to keep this really up to date. And now overnight, every quarter we run this and we look at and analyze where these metrics are going. And that leads us right into the second point that you just made. We can now run reports on any company that we care about. So if you can see this screen adjustment here, I showed you that I ran the Google report.
Mhm.
And by running the Google report, what we have here is we have a 41-page analyst report, and here it is. So this is, you can run this. These are all free and available on veritasalpha.com. So anybody can go and set up a free account and just log in and order these. Okay, so I'll just show you a couple of brief items. We have a full value line page that we've made.
Mhm.
Here we have some, just the price of the stock over since inception. We have the 20 years that I just showed you in that Wilshire Total Market Insight report. And then we start going through really detailed information about Google. Okay, we start talking about what happened in 2024. We talk about the business overview. We go through, as I said, a full SWOT analysis. We show the SWOT analysis here. We go through Porter's 5 forces. We have a full Porter's 5 forces framework here. We go through Scuttlebutt, where there are 15 questions that Phil Fisher presented as being highly important in analyzing the company. We go through each one: profit outlook and capital needs, management, communication, and integrity. We go through every single one of the Porter's 5 forces. We go through a risk assessment. We then go through things like valuation and short thesis. We talk about recent quarterly information. We go through entire transcripts. We do evaluation and show all the financials. So this report, if done properly by a senior analyst, would take weeks to put together. And I just ordered it at the beginning of this call, and it's right here. So I can now, because they're structured really well and they're consistent in structure, I can get through these reports very quickly. So if I want to learn about a new company, or if I see a company that shows up on the Total Market Insights report, the full Wilshire 5000, and there's something I want to see, I just go and run that report, and 20 minutes later, it's like I have an equity analyst, and I can actually take this report, upload it into something like a Claude, ChatGPT, Anthropic, Gemini, and start asking questions. And if I load a few of these and some competitors in, I now have the most informed analyst in the LLM at my fingertips. I mean, it just knows everything. I can ask anything, and I'm getting very high quality answers directly back. All right. And so now let's say I've gone through this analyst report, and I think I ran this one for Amazon. Sorry, this is Tesla. So I ordered this just before our call. So I ordered this Tesla earnings summary. So this is our quarterly summary that gets into the weeds on what's happening right now. And this is looks like an 11-page report, 3 of them financial statements, a few of them are covers and disclaimers. So again, you have the value line, You have all the metrics here for Tesla, and it goes into great detail in their latest earnings. So January 29th, 2025, what happened? Here's the executive takeaways. Here's the leadership sentiment. Here's financial metrics broken down by segment. Here's management's guidance. Here are the strengths and catalysts, the challenges and risks. And then we go through the full Q&A with the quotes directly from, for example, Elon Musk. Every analyst is asking very direct questions. We want to make sure that we see what are the important aspects to the analysts that are on the call asking the questions, and then the exact answers so that we don't miss a single word from someone like Elon Musk. And at the end, we show the financials, and this is a simple earnings assessment over the last 3 months. And we can, again, compare those across the sector or the industry. So we now have a general report that looks at the whole market, firm-specific analyst reports, and quarterly summaries of the recent quarter. And all of that's at our fingertips. It's all done by AI. There's no human intervention, and it can be done in a 20-minute. In 20 minutes, you order them, and they show up in your inbox.
Mm-hmm. And so of course, I mean, looking at this, I see that the depth of information that you're getting is pretty high. So you're getting basically all the information you would ever need, or you would spend a lot of time to actually get this information if you were an analyst yourself, or you were a value investor yourself, or whatever. So in that case, what do you think is truly the advantage that a investor has today, or a or a value investor or an analyst has today, or maybe even going 5 years into the future or so? Of course, because now there's more information, AI is learning everything. What gives you that edge to beat the market?
So I think that it's interesting what Eric Schmidt, CEO of Google, was recently talking about, ex-CEO, was recently talking about what's coming down the pipe in AI. And here we are in 2025. His projection was that within a year, many of these AI systems, tools, agents, etc., will surpass most human capability, a single human capability. So everybody will have this expert in their pocket that can give them medical diagnostics. They can analyze financial statements. They could be a great tutor. It's all just going to be available. And it's only a few years before we reach kind of AGI and we can have these AI systems outperforming the collective human intelligence. So we're like 3, 4, maybe 5 years away from something like that. What I have seen through our firsthand experience is that it allows us speed and scalability. So the scalability is absolutely enormous. In the past, a lot of the effort that was done was about collecting data, organizing data, building out models and spreadsheets, analyzing that over a series of years, and it would truly take months. Some of your viewers might know we went through an exercise with a company called Seritage where we valued 212 malls in America, and it just took us, half a day or day per mall, and then we would go back and cycle through them over and over again. So this is there's not a huge value add in doing that other than determining the value of the business. So all of this data collection and building a model in Excel, and we can just jump over that right now. And we basically made this available for all, but there aren't a lot of users because people don't know it exists, and we're just using it internally. But this is a massive scalability opportunity where now, instead of going and analyzing Nike, you can analyze Nike and Under Armour and Lululemon immediately and compare and contrast all of them and look across all sorts of different companies in a sector. So the scalability is absolutely enormous. The value, I look at this myself as a quality analyst on Wall Street, definitely is paid hundreds of thousands a year, call it $250,000 plus, and that would be probably on the low end for a senior analyst. And they're really only able to probably handle a couple dozen companies that they know really well. And that's not very many for what you're getting. So that if they're handling a couple dozen and they're earning 250,000 a year, it's like every analysis is 10 grand.
Mm-hmm.
And these analysis are now available for free. We pay a few tokens to run. We pay tokens to run these reports, but they're less than $10 and they take 20 minutes. So I believe we've condensed a month's worth of work, 10 grand worth of cost into a few dollars and 20 minutes, which is absolutely incredible. And even for us, we are so impressed with our capabilities. We are so pleased with what we're able to do. And I think if people don't align with AI, especially if they're true investors or if they're professional investors, they need to align with AI or they're going to get left behind. I was in Dubai a few months ago, and I was giving a talk on some of this AI work we're doing. And I started the talk. I don't want people to think that we're competing with everyone. That's not our intention. We're building this because it's helping us. I don't think that AI is coming for anyone's job. AI is not coming to take your job. But a human armed with AI is going to organically take your job. So you have to align with AI. That's where the world's moving. You have to put AI into your workflow. You have to start using it. You have to start paying for the subscriptions so you get high quality output, and that will allow you to survive. The firms that don't pick up AI are biased, don't believe that it's accurate, don't believe it does math. They're going to get left behind because they're incorrect. It does it all.
Mm-hmm. Yeah, that's it's very true. Actually, not even AI, but we've seen even in recent years, there's quant has grown rapidly on Wall Street. It has done fantastic. Jim Simmons did fantastic. He crushed the market for so many years, and he's got returns that no one's ever heard of, and that everyone would be jealous of. And I think with AI, it just makes that easier, and makes all types of analysis much easier, and that adds a lot of value to a lot of people. And even for retail investors now, you've got basically a Wall Street analyst. If not, you've got you've got someone who knows a lot about business in your pocket, or on your screen and stuff, and you can immediately refer to them and get advice. Or you could, of course, you want to be independent in your thinking, but you can get great data from them, or just in general good summary, a good report, so you could read and you can filter through a lot more ideas than you would normally be able to. You can be more informed about the world, and couple that with annual reports and stuff, and that does wonders.
That's right, Hede. But in fact, AI can hallucinate, as everybody's aware, but at the same time, AI can also avoid human biases. I mean, what is a human bias other than this sort of hallucination that isn't factually accurate? So this report that we're creating can run a bull bear base case DCF intrinsic value analysis, and then on the next page create a totally unbiased short thesis for the same exact company. And a human at a firm, it's very difficult for them to study and gather all the information, consume all the information that's available, and then come to a conviction in a bull case thesis, and then completely remove all the biases and then present to themselves a short thesis.
Mm-hmm.
They've already focused and trained themselves on that particular firm to study things that are going well and right, and it's much more difficult to remove those biases and then come up with an objective short thesis. AI will do it for you. You can read them both. You can understand them both, evaluate the probabilities of each one coming to fruition, and make your investment decisions based on that. And by the way, I don't think that this replaces analysts. I think analysts need to analyze the reports, understanding the financials, understanding everything that you understand and have placed in your book. Harry, the analyst needs to synthesize these reports to come to a conclusion whether there's an investment opportunity or not. There's still a huge number, thousands of companies out there. But I think if you run a series of these reports across the sector, you're going to find great opportunities that just jump out at you.
Hmm. Yeah, that's so true. And you just talked about biases, which is a very good a link to the next question I do have for you. And that is that um, your investment style is very focused on, you look at super investors for ideas, like you mentioned earlier, and even on your website, um, Bill Ackman, David Einhorn, of course, Buffett, Charlie, Fabry, Guy Spear, and then um, after that, how do you guard against all these cognitive biases that you have when making a decision, confirmation bias and overconfidence in your decision making? Because, I mean, if you've got on one side, you've got all these great value investors buying a stock, on the other side, you've got AI saying, oh, it's a great stock. How do you then maintain equanimity and then decide, okay, I got to guard against my biases and I'll think, you know, independently?
So it's challenging, but the first step is to know they exist. There are many investors, some are either even professional investors who haven't done the work to study psychology and human biases and all of the, I think, mistakes that constantly and continuously impact retail investors. So if you're unaware of the fact, people know to buy low and sell high, but that is much easier said than done. Because when you have the social pressure, social proof, when you're having commitment and consistency biases, it becomes challenging. And professional managers are not immune to these behavioral biases that exist in humans. We're all human beings. So when something is falling, even though you've done your analysis and maybe you've reconfirmed your analysis, it's all proper. But when the price is falling, it's very hard not to feel a little uncomfortable. And that's a definite human trait. And it causes a lot of challenges, even for the professional who gets scared out of stocks. So the first thing is to know that they all exist. There's a number of books that you can study and read to find out about these. Some of the core books are very good, and they don't seem to be in finance at all. But it's like How to Make Friends and Influence People by Dale Carnegie, or Cialdini's book on the psychology of persuasion or influence. Basically, these types of heuristics that humans use. In fact, I failed to mention Poor Charlie's Almanac, which goes through one of the classics of the, I think, 30 cognitive biases that just plague humanity. And it's like, if you're not aware that we all operate with some sense of denial stuck in our minds, then you're probably going to assume you're correct more often than you actually are. And so you need to discount your confidence level based on the known biases that you probably exhibit. So the unknown unknowns, the risks in your analysis that are unknown even to you, would cause you to pay a little less or take a slightly smaller position. So the first steps are knowing they exist. Then you can make some maybe strategic decisions in your life that would make them not impact you as much. Let's take a real example that harms people a lot. They log into their portfolio on a regular basis and they see all of the influence from whoever their prime broker is. They might log into a Charles Schwab. They might log into any different broker, into Interactive Brokers, and they suddenly have sounds and bells and lights and colors. And all they're trying to make you do is trade. And so if that's happening and you're logging in too frequently, you are definitely being influenced to overtrade. because that is what your broker would like you to do. And so one of the things you could do is maybe if you first of all, you look less often. That would help you avoid that risk of over trading. Maybe you only look when the markets are closed, so you're not watching it during open hours. Maybe you set up rules for yourself to only place trades as limit orders when the markets are closed. All of those are really good suggestions so that you're not overconfident, you're not overstimulated, and you don't suddenly make emotional decisions that are irrational instead of a logical, rational choice. So you set up rules to counteract the biases that you need to know will impact you. You are a human being. You're being impacted by all the things in your environment. If you wake up in a bad mood, you don't want to go and sell something because you're grumpy. That would be a terrible decision to make. You would like to logically go and assess the scenario, and you'd like to figure out the valuation, determine if the company is growing or shrinking, and then make your decisions accordingly. So it's about setting up in your environment the best you can to counteract the human biases that you know you have. And then hopefully you can overcome some of those biases. One of them is this bias of overconfidence. And so you see a lot of great value investors, they say, we don't talk about our holdings. The reason that you don't talk about your holdings, and I'll talk about an old holding right now, which is Seritage, we mentioned. The reason you don't talk about these holdings is because when you go publicly out and you say, here's a company I found, and it's extremely undervalued, and we're going to buy it, we're going to own it. It becomes very difficult because what happens is in value investing, to find an opportunity like that, you usually need to have a controversial kind of thesis, something that doesn't permeate through all of society yet. Otherwise, the price would be accurate. So you're going to go out there with some sort of controversial thesis and say, this company is priced incorrectly. The most common reaction is an outcry that your thesis is incorrect. So you receive emails and phone calls saying what you've done wrong. And then the natural and appropriate response is you sit there and defend this position. And that actually just pounds it into your head over and over and over. So you may have been wrong. There's a probability that you're wrong. There might be fatter tails in the normal distribution, as Nassim Taleb would say in Black Swan. So basically, if you know there's a probability that you're wrong and there's a probability that whoever's talking to you is right, and then you pound in your thesis over and over, it becomes very difficult to change your mind. So when you're promoting things publicly, and it's not really a promotion, but when you're explaining things publicly, it's very difficult to unwind that because you have so much social pressure to be consistent with what you've been saying. So, and this is biologically ingrained in us. This is not like we've been trained this way. It's not because of TikTok. It is that because early in our history, you were more likely to procreate if you were consistent with what you were telling your small society. If you were always saying something and then the opposite was happening, you were less likely to get a partner. And so Buffett will tell you, many people will tell you, these traits are biological. So they are like unavoidable. And in Cialdini's book, he explains 6 of them very clearly. You have social proof, you have authority, you have reciprocity, you have friendliness. These things all influence you in a major way, and it's biological. So it's unavoidable, even if you know. It's very unavoidable. It's hard to get out of that bias. So you need to know, set up rules, monitor whether or not you're being rational, irrational, and then hopefully avoid some of these problematic issues. But it's not easy, and I've watched many professionals make huge blunders, and it looks to be just like a human bias and psychological error.
Mhm. Yeah, it's so true. And with Guy Spear, I think he mentioned in his book as well, um, the one thing that he didn't really like, being in New York, being at Wall Street, or just in general, was that this was getting to his head. He was getting all these psychological biases kicking in. And I think he had a great example of a CEO that he met for lunch or something, and the CEO shouted at him, got pretty angry at him, and then he later finds out that okay, his wife is going through a divorce or whatever. So you've got all of these things around you that are happening, and then you can't let them affect you in your value investing process or your investing decisions, because then that will, you don't want to negatively affect um, your buying and selling decisions based on that. You don't want to buy a business because you're feeling fantastic today, or as you said rightly, you don't want to sell something because you're feeling like really bad, or you're having a horrible day, and miss out on that future opportunity that's going to come your way. And so um, one of the things Guy Spear did was that he left to Zurich, and then he found other things that could help him maintain his balance and perspective. So for you specifically, outside of investing, what interests do you have and hobbies that you personally have applied that allow you to maintain this balance, maintain this perspective, and stay calm when everyone around you is losing their mind?
That's a great question. I think over time I've evolved quite a bit, and so let me give you some specific examples. Uh, Being concentrated in your portfolio is almost, I would say, essential if you're going to have any hope of outperforming a major index like the S&P 500. If you have dozens and dozens of companies, one, it's difficult to watch them all, and it's also more likely that you have some mistakes in your portfolio. It's much easier. We hold 7 positions, and we hold them. I think about them as forever holdings, and we even refer to them as our infinite compounder portfolio. So not every single thing flows into the infinite compounder basket, but the majority and major components for our portfolio are there, which means we don't need to make decisions every day. We are looking to make really long-term bets, forever kind of bets, and we are looking to allocate capital at very strategic points when we get optimal pricing. And other than that, we're doing research. We're looking at for the new opportunities. We're monitoring things that are going on with our existing portfolio, but we're not looking to trade or move positions very frequently. This helps enormously, and I think it would help many investors. So many professional and retail investors think they're long-term investors, and it's hard for them to hold a security for more than a few years. Okay. I am very comfortable holding securities for decades. I think probably I'm 44. I've had some securities for 25 years. We've had positions in our fund since inception, almost 14 years ago. And that helps just maintain tranquility in our lives. So if Google or Baba price move significantly, we're more concerned with direction of cash flow and earnings and changes in management and risks within the firm at the really large level. So those are some of the things. Now, some of your viewers might be aware that we always use this structured value approach to buy our stocks. So for years, and it's become a little more well-known, but for 2 decades, the only way that I would buy a security is to sell a put, get paid first, and then buy the stock for the strike price. And that's still a genuine advantage and alpha producing step as you're buying into your security. Instead of listing a limit order that you like to buy the stock, you put a limit order on the premium that you're going to receive for the put, and as the shares decline, you get paid, and then you get the stock. So you buy it for below market prices. You pay less than a retail investor, but retail investors can do this. Now, over time, we've found out, and we've done so much back testing, and then we put it into practice, that we could actually run something similar to a wheel. We started running wheels around, we call it structured dividend capture. We started running wheels around the dividend payments and genuinely getting very high returns. However, over the last couple of years, what I've noticed it's quite clear to me is that it's a little bit challenging to run both a long-term value portfolio and then structured dividend capture where you're like trading all the time. It's a very different set of skills. And so similar to how you mentioned Guy moving to Switzerland to sort of incubate him, create a little oasis where he's not constantly being pressured to look at a new stock or buy something different. We've had a huge demand internally for this structured dividend capture and really our cash management procedures. We're getting really high yields on our cash. We'd like to have it in the long-term compounding portfolio, but those opportunities don't come along very often. And so what we've done is by getting a really high yield on our cash, it allows us to be more patient. We don't have this drag on our performance because we're holding on to cash. We can have a really liquid portfolio. We're picking up premiums and dividends, and then we can allocate to a great opportunity. So what we're doing, because a lot of people have asked if they could get more exposure to the cash management. And so we evaluate a lot of this and we're working on it right now. And I think later on, near the end of this year, we'll have everything up and going. So we're launching Titan Strategic Income, which is another fund. And we have another portfolio manager for that fund, very much aligned with everything we've done. And they will be managing the fund. And so outside investors, partners will be able to allocate to that fund if they want more exposure to cash management. Also, Peterson Capital Management, our long-term compounding value fund, when we have cash, we will simply sweep it into that fund. We won't pay any fees or expenses to the Titan Fund for our internal partners, just so everyone's clear. But it will sweep into that fund, and that will be managed then by Titan Strategic Income. So that will ultimately allow me to sort of, in a way, outsource something, even though we're still owners. We outsource that trading, the mechanical aspects of it, because it's creating a lot of cognitive dissonance, and it would happen to anybody. If you're constantly focused and talking and writing about how you want to be a long-term investor, but then in your daily life, on the weekends, you're placing trades that are all going to transact in the next week, you're playing two styles at once. And so we're trying to segregate some of these so I can focus on what I'm best at, which is long-term value investing. And then we can outsource some of the things that we've discovered that do work and will continue to work. But now I can separate myself from that. So just like Guy moved away from New York, I'm going to move a little bit away from the trading and cash management strategy that I brought onto myself, but I'm still aware of it and I'm still involved. Guy Spear still visits New York. Mm-hmm. So these are some of the strategies that professionals use. They really incubate themselves very much in the way that Guy has, so that they can operate very mindfully. Some people will make their Bloomberg terminal, if it's sucking up all their time, they'll make it very difficult for them to use it. They'll put it on the floor or something. So you actually have to get on the floor to go use your Bloomberg, so you don't spend all day looking around on your Bloomberg terminal. Okay, so there are a number of techniques, and you just need to be really, I think, self-aware, evaluate. You need to be aware of the biases, and then you put in a plan and you execute, and that will help you over the long term. Because this is not an easy business. It is a very difficult business, and there's extreme competition. I think there's a lot of individuals, retail investors, don't understand that this is like playing in the NBA. I mean, if you don't have an advantage, it's hard to win, because the people that are really playing, the professionals, they have built enormous advantages into their life, and you're kind of going up against those people. So it's a difficult game to win. You need to be aware of the cognitive biases. You need to be aware of how short-term thinking impacts you. You need to be aware of the social proof brought on by your neighbors. You need to be aware about commitment and consistency when you explain the things that you've found to your neighbors. All of these challenges are very real, and they cause people to underperform.
Mm-hmm. Yep, and it's I've actually heard a lot of people having two types of strategies, and maybe I think that helps a lot of people in the sense that you've got your core value investing portfolio and you don't want to touch those companies and mess things up because you feel like trading or you feel like you need that thrill of buying something and selling something, or that you need more returns on your cash, or any of those reasons. And so a lot of people do have, an alternative where you play that game to let your cash grow when you're waiting for opportunities. So I think, you Buffett kind of had it with his arbitrage thing early on.
That's right.
He was yeah, when he was running Berkshire, he did arbitrage, holdings and stuff. And I think that, and now he does, T-bills and stuff because he's too big to do this kind of merger acquisitions and corporate spin-offs and all these actions that happen. So yeah, and then on the trading side as well, a couple of people have maybe a percentage or so, and then you just 2% or a percent, and you just trade with that. So you kind of calm your mind down, and you prevent that bias from creeping into you, or you prevent your mind from being, forcing you to make a irrational decision. So yeah, I think that's a fantastic suggestion that you've made, and I think that's really good advice. So
Herday, I'll give you a quick example of a really common market practice that often leads to mistakes. And that is that a lot of people decide to short. They short something. And there's professionals who have shorted things in public, and you can see what happened. You can also see that Charlie and Warren never short anything. And you might want to start to ask yourself, why would the best investors in the world never apply such an obvious strategy? There are long short funds. You see Bill Ackman short Herbalife. You see all sorts of things happening like this. The challenge is there's so many layers to the challenge of shorting. First, you're looking for long-term buys, and then you're going to focus on a short. Second, the short can go against you way further than any of your long-term can. So often what happens when you have a long-short portfolio is you spend way more time dealing with the short than you would with the long. And the outcome is not, things don't always need to fall when it's a terrible company. That's part of the problem. You get some inflation, some change in the macro environment happens. And if this company does survive, that short position you took is going to put you into a short squeeze, and it's going to hurt everything else you've done in your portfolio. Furthermore, just like you saw with Bill Ackman, you're going to have to run around talking about how this company, where there are real hardworking people who are alive in the world who think usually they're doing a good job, you're going to have to go around and talk about how terrible they're doing. You're going to talk about how bad the CEO is. And then because of many things, including a little bit of reciprocity, those folks, or revenge, those folks are going to go public about how terrible you are. So you're going to end up in a very public battle where you're all fighting about who's worse. And it's a terrible way to live. And it's a terrible thing to try to squash a company that has a bunch of employees. I'm happy that there are some short sellers out there, but the challenge is doing both. If you're going to be long, you got to be long. If you're going to be short, go ahead and be a short seller. It's a hard life. I don't recommend it. But if you want to be a short seller and take that path, try to stick to the short seller. Because if you try to combine them both, you end up doing a worse job at each. And it's hard to get great returns. At a minimum, at a firm, when you're running a long short fund, you should have different individuals doing each component. But there are so many people out there that are trying to run their own portfolios. They find some company they believe is a overpriced company. They don't like it because they don't like the product, because there's some gambling going on, or there's some, I don't know, British American tobacco, so they short something. And it's just not a very wise decision. It usually ends in a mistake. It usually ends in a loss, and people do it all the time. And that's just a very simple thing where people try to incorporate a whole bunch of different strategies into one portfolio, and you can't do everything well. And so they end up suffering because of it.
Yeah, that's very true. And shorting specifically, I think Munger I think someone's asked him before, and he said it's just the odds are against you when you're shorting. Um,
Yes, it's not even worth playing that game. The odds are financially against you.
mhm,
And then the toll it takes on you as an individual and the pain that you're bringing to, if you're an influential public figure and you're going to go out there and tell everybody that a product's terrible, uh, you're going to get some backlash. And it's also sort of a hard way to live your life. You're
mhm,
just collecting enemies. So, it's easier avoided. Charlie Munger always told people all the time to avoid it. I've had deep discussions with Guy Spear about how important it is to avoid it. And yet even professionals go in and do it. You'll see Bill Ackman is very public about it. He's changed his mind and he will not short. And I know fund managers that I won't mention who shorted something, destroyed their track record, and shut down their funds. So it's a very dangerous situation when you go in and start shorting. It starts to look, we're here in 2025. We've got volatility back in the markets. People are slightly concerned. Things are a little bit high. Somebody might decide, hey, they're going to go and short something. I just think genuinely, it's the wrong approach to take. And it's kind of like combining a long-term portfolio with some short-term trading. If you want to do something for fun, you're just gambling with it, fine. Don't expect to make any money. And if you do, you're lucky.
mhm. Yeah. Instead, I think they should expect to lose money probably. Um, and then, yeah. Also, I feel when you go long in a company and you is in a way you're supporting the company's growth and you're playing a part in the wonderful business that there are, and it's so much easier to focus on that side of things. Um,
It's absolutely wonderful.
mhm,
So, for example, we bought into a position called Daily Journal maybe 6, 7 years ago. And Daily Journal used to be run by Charlie Munger. Not a lot of people knew about it. It was like way below, and now it's maybe 500 million market cap, and they have about a $300 million equity portfolio inside that was built and run by Charlie Munger. But Charlie's gone, and Stephen Myhill Jones has come and taken over as CEO. The board is stacked with Charlie's friends, just incredible individuals, incredible. It can't be overstated. We have Lee Lu helping out with the portfolio a little bit. And the stock is super volatile. At the beginning of the year, it's at 600. I think now it's below 400. And it doesn't matter at all. And we're long this holding. We have a little less than 1% of the whole position. We'll probably hold it for an extremely long time. I have minor IRAs for my children. And Daily Journal sits in their Roth IRAs in case something happens to me. They never need to touch it. I mean, my daughter is 10. She might hold this for 60 years. So that gives you so much peace to just know you're owning it and it's a great firm. So I see and I watch the things that Stephen Myhill Jones is implementing. He's de-risking the business. He's making it more capital light. He's helping to incentivize the employees. He's structuring things that give them a real path to success in their careers. All of these things are long-term plays that are enormously beneficial. They'll build up a better uh, quality of internal staff and everything else there. It's a really great way to approach this. And we just get to be long and we're silent cheerleaders. And over the period, I've gotten to know Stephen Myhill Jones. He's a wonderful guy to be running this firm. So we're very, very pleased with a company like Daily Journal, not that concerned about stock prices. And when it gets very low, I think it would be pretty incredible for it ever to get to 300 again. Uh, it's cheap and you can just buy it for the long term. And that's just such a great way to live. You're going to make a great return. You're going to have ownership in a high quality business that's doing great things. They're implementing court software solutions to courthouses all over America and some in Canada and Australia. Revenue's growing, everything's working, and there's some bumps in the road, but we've got great management teams. So when there's a challenge, I trust that management's going to make some really high quality, rational decisions, and they're going to, beat the competition because they're such high quality thinkers. So that is a great place to be. And you can imagine the alternative is you find a company that maybe doesn't have a good business model and has a bad CEO, and then you've got to go tell everybody about how terrible they are. And that's just a much different way to live. And it's a hard mentality. And you're kind of defending yourself against everybody else who is going to work and working hard. And it makes it hard.
Hmm. Yeah, that's really true. And you've got um, you of course it's fantastic to have great management here. And Buffett said as well, Berkshire is a project that's going to last 100 years, 200 years from now, even when he's gone. And I think that's probably the same with a firm, Munger's built up, and um, the two of them are fantastic long-term thinkers, and they've got the right models just set in, or the right culture in the businesses that they operate. And so, I would like to ask you if you have any specific investment case study that either exemplified this approach, or made you realize the value of um, certain parts of the business, or certain advantages or management or stuff like that. Or it could be that you learned lessons from, so that that helped you make better decisions down the line.
Uh, I'm a lifelong learner. I'm learning lessons every day. So I can share, I think, a few rules of thumb. Like, you have to be a bottom-up investor. Very, very difficult to understand every nuance in macro. And then there's so many fat tail events that could occur and things that you won't consider. Uh, it's nice to have a great tailwind, but other than that sort of a macro tailwind, and you probably don't want macro headwinds, you need to go bottom up. So I think I'll give this example that I started to mention earlier. We valued Seritage. Seritage was run by, it was Eddie Lampert combined Sears and Kmart. And then Amazon showed up, and Sears was filing for bankruptcy. Prior to it filing for bankruptcy in about 2015, Eddie Lampert spun out all of the real estate assets that Sears had owned into he did a sales leaseback agreement where he sold the assets, and then Sears leased those assets, and they combined them in a company called Seritage. Seritage got bought into by a bunch of great value investors, including Warren Buffett. And then Buffett's Berkshire ended up lending a few billion dollars to or a couple billion dollars to Seritage, so they could do this capital recycling plan where they sold off the lower tier malls, reinvested the capital into the Class A malls, and started compounding those assets. Unfortunately, things didn't work out quite as planned. We had so many unique hits to the commercial real estate market, and they just came in quick succession, one after the next, from pandemics to higher interest rates. There were so many different challenges. And ultimately, we valued every single mall that Seritage owned. So there were 212 malls, and we had massive spreadsheets, and we're figuring out all sorts of cap rates. We're calling brokers. We're trying to understand exactly what they could sell for. And when you add up every single mall, because that's where all their assets were, you had the value of the company. And we watched the value of the company slowly step down as rates went up. And it went from about $28 a share that we were looking at to $18 a share. And there was a point when the shares were trading for just under 12. We valued them again, and we realized the share value was now $12 a share. And it was alarming because we had been holding a position in Seritage since a price of $6. After the pandemic hit, we bought in because it was so obvious. But after the pandemic, when rates were up a lot higher, cap rates had changed, the valuations had all shifted. It looked like it was swinging the other direction. And because we had spoken publicly about it, like I'm telling you today, it was a challenge. I knew it was a challenge because I knew I was biased in the wrong direction. So when things started to align where we said, oh, it's barely fairly valued, our previous biases let us know we had to sell. The trend was that it was going down. So we ended up exiting, and you may know, investing with Tom out of New Zealand, sorry. And I did a podcast about the day we had to liquidate quickly. It was alarming what was happening, and Powell was about to raise rates again the next week. So we exited after about a year of the position, and we made a really great return. We only were able to do that because we had done all the work and valued every individual mall. And when we saw a mall sell, we could see how our price compared, and we tracked it for years. And when that inflection point occurred, we exited and made a great return. We went on investing with Tom. We said, look, we've said in the past it's a great investment. We've changed our mind. It's not a great investment. And again, we received a lot of, it was very controversial at the time. Buffett was still a holder. There were still holders out there. And we were out there saying, as much as we said positive, it's going down. We didn't short it. We just said it's not worth 12. That is for sure. In fact, I believe I said it's worth less than 6. And people resisted our claims, but today it's selling under 3. And it's only been about a year and a half. So we were absolutely right. Bottom-up analysis is key. You have to understand the true economics, the business you're looking at. What's the business model? Who's the management team? How are they going to perform in certain environments? And if the environment shifts and suddenly you find yourself in a scenario that you didn't like, you need to be comfortable. Even if you were hoping to compound for a lifetime, you need to be comfortable pivoting and exiting very quickly.
Yeah. Yeah, I think as the facts change, you should change your opinion as well, and change your mind.
What else would you do, sir?
And that's a Munger quote. Yeah, but it's a brilliant piece of advice. So
The church reform as well.
uh yeah, so yeah, so I would like to ask you on what is the best piece of advice that someone else has ever given you, or what's one advice or a takeaway that you've found that has been fantastically helpful, value investing wise, or even beyond?
There are so many important pieces of advice that I've been lucky enough to receive from mentors and friends throughout the years. So it's hard to identify the single most important. But I think if I had to say something that would just benefit most people, uh, Arnold Vandenberg has been a huge influence in my life. And he quite literally has trained himself to never have a negative thought. It's phenomenal. If something terrible is happening, he just finds the silver lining immediately, talks about that, moves forward, and steps over it. I mean, nothing keeps him down. And he even has told me things like your subconscious is presenting 14,000 thoughts to you per day. Most of them are habitual. So you have to be incredibly careful what you think, because if your thoughts are in a negative state, you're constantly pushing that into your mind. So he asked me once if I had a black pen and a yellow pen and a sheet of paper, and I put a yellow dot every time I had a positive thought and a black dot when I had a negative thought, how would my paper look at the end of the day? And I said, I don't know. I guess I'd be a splatter of black and yellow dots. And that's the wrong answer. He said his is just yellow. Doesn't have any negative thoughts. And when I see him like opening up his wallet or putting something in a cabinet, it's strange. It's not strange, but it's strange at first. He has positive affirmations all over, so that when he has a negative thought, he actually just goes and starts saying, I am healthy, wealthy, and wise. Or he starts saying, I am every day in every way, I'm getting better and better. And he just eliminates that negative thought. So he believes, books like Think and Grow Rich, just incredible, incredible, timeless knowledge in there. And he's studied and practiced it for maybe 60 years. And he came from a point leaving the Holocaust where his life was very troubling. and he had to train himself. And to this day, he credits, I think, most of his success to this incredible mind shift where he went from being down and upset and complaining and worried to being very positive and excited to being helpful, to adding value. And it has totally transformed his life. And he is like on display and alive preaching it today. It's quite it's quite incredible how positive he is and how he doesn't let anything get him down.
Hmm. Yeah, it's. I think optimism. It is a fantastic virtue to have. When I went and met with William Green, one of the things he told me about was also that that you should be um, really optimistic. You should think about what you tell yourself, and he believes a lot in you know affirmations or affirming the right things to yourself. If you're gonna tell yourself that oh you're horrible, you're not doing anything right, all your investments are gonna fail, or whatever you tell yourself, it's going to backfire because somewhere or another your mind picks up on it, and and so um, so yeah, I think that is probably a very good piece of advice from him, to just stay positive and stay optimistic, and especially nowadays when people are being, overly pessimistic. We're seeing the stock market go down. We're seeing a lot of people, be really negative about things. I think it's good to just see the positives that are happening all across, and just be optimistic in general. Um,
Yes, and that's exactly right. And I don't think you need to be irrationally optimistic. I think you need to be rationally optimistic. And things are in general getting a bit better. And just over long periods of time, things are improving in the world. And a lot of people don't understand that they're actually improving in this way. Things are getting more productive, more efficient, uh, longer, uh, improving longevity, etc. Napoleon Hill really describes all of this and the benefits to your entire life. You know, Arnold would share, and so would William Green, and they know each other quite well. And Guy shares all of these same views, but it's really about imagining where you want to go and leading a thoughtful life. And when things set you back, like Ray Dalio, those are learning experiences. So you have to be willing to accept and move forward. So, a lot of people get knocked down. Everybody gets knocked down in life. Charlie Munger just gets back up, and that's the difference. Most people go down and stay down. You just go down and you get back up and you keep walking forward. And those are the people that are really successful. And uh, you have to have a real, I think, deep level of confidence in yourself and capabilities. And you train yourself by giving yourself positive affirmations to stand on. And Arnold, at 85 years old, is telling himself every day, many times a day, things like don't sit if you can walk, don't walk if you can run, don't stand if you can. I got do it again. Let's see if I can do it again. Don't sit if you can stand, don't stand. If you can walk, don't walk if you can run, and if you see stairs, climb them. And he does it. He's these affirmations are all around him and they're embedded in his subconscious, and he doesn't have negative thoughts, and his days are outstanding.
and the Munger story is fantastic as well. The fact that, at 30 or at 40, he's young, and he's divorced. He's burying his son. He's
He lost a son, he's divorced, he's walking around Omaha crying.
hmm and
Yeah,
and from
it would
that.
have taken everyone down.
hmm yeah, it's just unbelievable how he soldiered on from that point in life where it just seems like everything has gone wrong, or everything that you find worth living for no longer exist, or suddenly you're in this huge bunch of pain that you've never experienced before. And so yeah, it's unbelievable that he came back up from there, and he left us with such a brilliant legacy behind.
Right. And if you think about his early partnerships as well, back in finance, he had some extremely volatile years. The 2 years before he closed his fund, he was down maybe 70% or something. And that in itself is very difficult. All of your partners complaining, and Charlie himself had made a reasonable investment that rebounded a couple years later, and then he closed the fund. Uh, it's a time, we're in this volatile period. We've seen the S&P rise for, pretty consistently for about 15 years since the financial crisis. This has really influenced people in your generation, even people in my generation. They've never really seen this downturn, and they sort of are blind to what can happen. And so when these tariff headlines hit and markets start to move in different directions, it becomes very alarming. But it's really common. And over the course of a lifetime, you're going to see recessions, you're going to see corrections, you're going to see bear markets. And if you're not ready for that, if you're not prepared for that, you probably shouldn't be investing in the stock market, because it's almost unavoidable. I mean, you're basically, we're in a period now where multiples, as we showed in some of these reports, are pretty expanded, and earnings have been growing for a lot of years. So, we had a slight downturn in 2022. We're here in 2025. It wouldn't surprise me to learn that the US is in a recession. The S&P, NASDAQ, and Dow are all in correction territories. I think the NASDAQ has hit a bear market. The other two have not. I know that when the S&P does hit a bear market, there is a 50% chance that it ends up 35% below its peak. All right. If we're down right now 15, 16, that means we have another 20% to drop if we go beyond 20. That's a 50% chance. So if we fall another 4 or 5%, then we have a 50% chance of falling another 15%. And during those periods, maybe you're intelligent and ended up with some cash somehow, sold some good investments like Buffett's doing with Apple. Or maybe it's a time when you have to make some money back, but you don't need to make your money back the way that you lose it. And that's another common problem. People lose money in a security and they think they're going to hold on, and then it goes back to zero. But they're probably in a low quality security. And what they should really be looking for, and what you get an opportunity to do, is in a crisis, you upgrade to quality. So there's very few times when you can get a great business model with a great management team at a really low price. When those opportunities occur is usually when there's a full-on recession crisis and everybody's maximum fearful and they've sold everything, panic sold. Probably you've had some leverage in the markets and some blow-ups in the markets, and prices have become irrationally low, and you upgrade to quality. So I think we're probably approaching a time when I think the S&P over the next 10 years has a very low chance of doing anything like it's done over the previous 15 years. It's like impossible. So we're probably looking at some lower returns, and I would expect over the next 5 years or so, at some point we have bear markets and a recession. Every 2 years we have a correction. So it's not alarming, but it alarms society on every single time. And so if you understand that these corrections are going to come and the bear markets are going to come, and that you want to upgrade it to quality during those times, it really does present an opportunity, and it's less devastating, and you don't need to be as concerned about it. You're just looking for the top quality companies that you can buy when the prices get to 20-year multiple contraction lows.
Mm-hmm. Yeah, and it's I actually looked at a chart, and it's pretty normal for us to have drawdowns once in a while, and you have like I think a 50% drawdown roughly every 20, 15, 10 years or so, and you get massive corrections going on, and as you rightly said, every 2 years, every 3 years, you have a 10% correction or even more. We had one in 2022, so it is pretty normal. But somehow every single time it happens, people get, you know, filled with panic and they get taken completely by surprise, and they just expect, perpetual rises in stocks and valuations and earnings and stuff. But it's not going to happen. Um,
This is just a rule of thumb, but I think about it like we're going to have a correction every couple of years, and probably out of every three, one turns into a bear market. And we have recessions about less than every decade, more often, sorry, than every decade. So uh, we're bound to have many more recessions in your life, many more recessions in my life. And if you're buying and holding a great long-term company, you want to buy those companies at maximum multiple contractions so that when things perform well and we move to the new bull market, you'll get multiple expansion and earnings growth. And that's what will deliver really, really large returns. I think it's Chris Meyer who wrote 100 Beggars,
mhm.
and he explains a lot of that in throughout 100 Beggars. And you need to have a really concentrated portfolio. And the way that you're going to get a huge gain, like 100x, is you hold for, I think Southwest Airlines might have done it the fastest in 7 years, but many of them took 25 to 30. But they've turned $10,000 into $1 million. And these are huge returns. They're outlier returns, and it's possible to find these, but you have to be super patient, and you have to buy them during a crisis, typically, and you're going to buy them with low earnings that are going to grow, and you're going to buy them at really contracted multiples.
Right, and Buffett has also said, I think, that um, many of his best decisions were when there were some macroeconomic downturn or something that affected the general market and had nothing to do with the business, but it was just, the market was just selling fantastic businesses for really, really cheap valuations. Um, yeah, so and even he talks about it. I think in one of his lectures, he talked about how um, the worst of his mistakes are ones where he sold before they've actually reached their fullest potential or gone high enough, and those don't show up on the balance sheet of Berkshire, but they are actually the mistakes that he is most guilty of making, and the mistakes that he feels the most remorse for, because he's smart
Yes.
enough to find it, but he just wasn't smart enough to hold it long enough.
Yeah.
um, yeah, so
There's mistakes of commission and mistakes of omission. And when you buy something and it goes down, you've made your mistake of commission. But many times you pass on something. He passed on Google for years, even though Geico was buying all the Google ads, and they just didn't see it. And so they passed, and it was a huge opportunity. Big mistake of omission. But then you can have a selling mistake of commission, and Buffett's talking about that, selling too soon. What's interesting is that when you get a Phil Fisher type compounder and you've done your homework, your research is done properly, the right time to sell is almost never. It should be compounding. It should have a great return on equity. When macroeconomic events hit, it should have an outstanding team of high quality capital allocators in the management C-suite, so that they can navigate the turmoil and come out on ahead. So what you're looking for in these Phil Fisher investments is an evolving firm that can move with the times. And if you find an impressive firm like that that's growing, even when it's fully valued, even if it's overvalued, which is difficult for us value investors, the right time to sell is almost never. You're going to sell, you're probably going to pay taxes. For US folks, you're going to pay your taxes on your long-term capital gains. You're going to start with a lower capital balance and go invest in a new company that you don't know as well. And then the risks are going to become clear, and you're going to realize you maybe bought a worse company than the company you already had owned previously. And it happens to be quite often. So when you get into a Ben Graham situation, the habit is to sell as it's approaching intrinsic value because the company might not be growing. But when you have a Phil Fisher investment, when you're looking at a Google or you're looking at an Alibaba or you're looking at a business that's going to be around in 30 years, daily journal, uh, the right time to sell is almost never.
Hmm. Yeah, and I think Munger was one of the first key, uh, maybe probably the first guy who made this, popularized this, and figured this out and switched Buffett away from selling too soon and just holding on forever and ever. And it's just easier to hold forever companies that you see
Munger
in
is
the market.
absolutely the architect, and I give him a lot of credit, and Buffett and Munger both give credit to Munger for shifting Buffett's mindset from a very profitable Ben Graham approach that wouldn't scale to the levels they were able to scale Berkshire.
Hmm. Yeah, because as it grew bigger, it was just harder for him to find that, and and I think Munger is. So I've going on the Berkshire Hathaway meeting in 2023, which was Munger's last meeting and my first one. So I feel really grateful to be able to hear Charlie Munger live one last time. His final show. So yeah, he's fantastic, and he's someone who has had, I think, a lot of impact in general. Buffett as well. Buffett's been. I mean, of course, you can't overstate how great the two of them have been. Um, and so this would be probably my last question for you. And I ask everyone this, or every guest on my podcast, this question, and that is, for any young investor or someone who's just getting into value investing, or someone who's got a lot of runway ahead for him, what do you think is the most important thing to focus on, or the key lesson to take, from which do you think is probably the most important in to succeed?
I think as a young investor like yourself, one of the most important uh, advantages that you could give yourself is to become very familiar, probably with a living portfolio manager, but it's okay to also focus on the dead portfolio managers. But you need to start really incorporating their practices into what you're doing on a regular basis. Sometimes you'll see something that maybe you don't even understand, but you should still try to implement it in that way. And if you do so, I think you'll find you jump over a lot of your peers that are trying to learn everything themselves. If you sort of trust and learn vicariously through an expert, you will find that for some reason, and you're not sure why now, but you shouldn't be shorting. So don't short. And you learn these lessons that these professional gurus have been sharing for, in some cases, for decades, and you just blindly accept them like a religion. And over time, you'll realize you avoided a series of mistakes by doing so. And when you look back, it will become very apparent why they are doing that. So you can just look to these mentors that you may or may not have even met, and you can really start cloning their actions and activities. Nobody's going to give you permission. You don't have to ask anybody for permission. Just like you went out and published a book, it's that same type of attitude. So if you go out there and you're looking at the greatest and you're implementing things, and uh, you're not biasing yourself by maybe challenging some of the unconventional moves that you see. Charlie Munger used to say, we can't teach the new dogs the old tricks, but if you're just blindly copying what some of these managers are doing, you will be implementing the old tricks. And then over time, you will start to learn the old tricks.
Hmm. Yeah, I've personally felt that a lot when I wrote my book. I felt like I jumped um, a huge leap. I took a huge leap ahead in my knowledge, particularly because you had to do a lot of research on Munger and Buffett and even someone like Phil Fisher and um, the lesser known names as well, David Dremen, and just figuring out every single different style of investing, and you learn a lot, Nick Sleep, and things like that. So, um, yeah, I think that is, and I think the one of the opening quotations in my book was that is this Isaac Newton quote where he goes that one of the reasons that he has been he's able to see so far is that he stood on the shoulders of giants. So
Mhm.
um, so yeah, I think that has helped a lot. I think picking out the winners and mentors in your field and then just emulating them, following them, cloning them. Pabrai did that and it worked wonderful for him. Um, and so yeah, I think that's something I'll of course keep in mind. But I think a lot of people, for a lot of people, I think that's really, especially when you're young, that's a really good advice because I think when you're young, you have this sort of feeling to just figure out all yourself and go out there and do it your way and things like that. But this actually does help a lot. Yeah.
Yeah, you don't have to recreate the wheel. There are truly experts out there, and they are doing exactly what you want to be doing.
Hmm.
Many of them are operating in public, so it's quite easy to clone them. Even if they're not public, their 13Fs are public on the SEC site. There's a lot of things you can learn, and it's you don't only have to learn from the other investors. Uh, we own Daily Journal, as I mentioned. Now CEO Stephen Myhill Jones. And it's quite interesting. There's a tech firm doing software implementations in courthouses. But here we are building an AI tool. And when I see that Daily Journal has a specific strategy or Charlie Munger was doing something in a certain way, we absolutely implement that in the same exact way to our AI functionality. We try to incorporate the positive feedback loops. We try to design things that will add way more value to the user. We there's just the list is endless, uh, but maybe it's finite, but it's large, and we're constantly learning from how Daily Journal is managing their internal software practices and trying to implement that in our AI solutions. And so you can grab these nuggets of wisdom from all over the place. And as Charlie Munger would always say, you need to go through life collecting these bits of worldly wisdom. And I think it's Shane Parrish who wrote, well, he wrote Clear Thinking, of course, but he has three books that I just love. Uh, and he goes through all of the mental models
Hmm.
that Charlie talked about. I'm not, what do you know the name of these books? Um, they're somewhere back here, but wonderful books. And you can just go collect them and read them. And if you don't think that critical mass has anything to do with investing, you should go read the books because there's so many pieces of worldly wisdom that are like basic high school uh, mathematical concepts or science concepts, and they apply to investing. And you want to be incorporating those. You want to be learning and using those. So there's a lot of ways that you can pick up all this information. But if you're a young investor, I would suggest you just follow some experts and watch them very closely, learn what they're doing, and try to implement it yourself.
Yeah, with the Shane Parrish thing, on he's got Farnham Street and stuff as well, and I think that's a fantastic blog, and I actually referred to it a lot when I was writing my own things because um, he looked a lot into Munger, he looked a lot into these great thinkers and just how they thought, um, first principles, stuff like that. That generally,
Mhm.
you know it from the beginning that this is probably the right way to do it, but you've just been trained or you just have not done it in that way, and then you realize how foolish that was. And the great thing about his book is that he also makes it um, very much like Munger said that you can't have them all lying around everywhere and anywhere. You gotta have a lattice work where all of them seamlessly link into each other, and then you can think through it and and build connections, and then reach some point in time where you think, okay, yeah, this is what I should use, and this is what he's talking about. This is and stuff like that. So you've got to have a lattice work. And so yeah,
Yes. And in fact, the book I was referring to, I looked it up, The Great Mental Models, General Thinking Concepts.
mhm.
There's 3 volumes of these books, and I really like them. They're wonderful. I asked him to sign them for me. I think they may be slightly out of print or a little bit difficult to obtain. But he has his newest book, Clear Thinking, and that's out as well. But I just really like the way that he designed these mental model volumes. Three volumes of the great mental models to keep in mind.
Hmm. Yeah, it's fantastic, and I think you can get them online, but of course, the hardcover is probably a lot of people like reading on hardcover, and so yeah. Um, but so yeah, I think that's a wrap. Thanks for sharing so much worldly wisdom, or sharing so much of your knowledge and your experience in markets, and um, conversations you've had with other people, and anecdotes and stuff like that. And I had a wonderful time talking with you. I hope you did too. And thanks so much for joining my podcast.
Yeah, Herode, thanks you for bringing me on. Thank you for the invitation. And I'm glad we were able to do this, get it all scheduled, and I hope we added some real value for your audience.
Yeah, I think we definitely did. Yeah. So yeah, thank you so much once again for that value.
Thank you. Talk to you soon.